This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Mish Shedlock joining us here this morning from Chicago. Mish is a well-respected and prolific writer on the web and publisher of the Global Economic Analysis blogspot.com. That's a mouthful, Mish. Welcome.
Hey, it's a pleasure to be back on the show. You're doing pretty well with this financial repression series, aren't you?
We are. Mish, we just went up over 715,000 downloads. Now, if porno, that's not big numbers, but for a subject like this, it's amazing. We've had some just outstanding guests, and so we've really enjoyed it. Mish, what we're doing now is we're shifting a little bit from talking about what financial repression is, and you were on in the fall, and I need to refer our listeners to that show where you really laid out what it meant to you. But we've moved into the issues associated with financial repression and solutions. And one of the central issues is the whole issue of pensions and the pension problem that well, we already had a pension problem, but how it's even making it worse now. And in my opinion, really moving it where pensions are no longer risk-free. I wonder if we could begin by, well, do we have a pension problem in America?
Well, you know we do. And I live in a state with one of the worst pension problems you can find. Illinois pensions in general are something like 39% funded, and that is after this massive rally we've had since 2009 in financial assets. Pensions are only 39% funded on average. Some of the worst ones are about 20% funded. I think the teachers' pension plan is about that funded. The General Assembly and judicial pension plans are also on the bottom. They're smaller, but still, when you've got an aggregate funding level of 39%, Gordon, that's just not good. And that's Illinois. Various cities in Illinois have problems, Chicago being one of them. Chicago has a huge pension crisis right now, and Chicago has taxes on the slated they're trying to get passed. We've got something called home rule taxes here, where cities can levy their own taxes in addition to the state. That's why we have varying sales tax rates that range, anywhere from 6% to 10%, depending on locality, under something called home rule. And of course, Chicago has one of the highest taxes. And but Chicago, I believe Chicago is bankrupt. And in fact, I've been working with the Illinois Policy Institute. There's a number of cities right now in Illinois. I'm not going to name them, but I'm aware of 5 cities, one of them a major city, not Chicago, although I believe Chicago is bankrupt, that are ready to file bankruptcy. And it's all over the pension issue. The problem is, they can't file bankruptcy because the state doesn't allow
it. Mish, what is the fundamental issue? They're not putting enough money in. They're not making sufficient income on the money that's being invested. But I suspect there's more going on than just that.
The fundamental issue is they've made more promises than they can possibly keep. We've got a boomer demographic. All these people are retiring. You have police and fire workers that can retire after 20 years. Some of them are doing that. They can retire at age 55, 56, 54. Some of them and collect up to 70% of their pension, and it's based off of their 5 highest years' salary. So we see a lot of pension spiking in the last few years of a contract where police work overtime, and that overtime counts towards their highest 5 years. So these guys stand to collect far more in retirement than they actually made ever while working. And
never mind what they even paid in, right? So they paid in very little, and there's just a huge gain that's coming out of it. And they're, as you say, making more than they made when they were working. on an annual basis.
Well, the weird thing is they claim they paid in all the money. They ain't paying this money, Gordon. Taxpayers paid in the money. Taxpayers are actually funding, their portion of it by excessive wages, by direct contributions. Now they claim, and kind of rightfully so in this regard, that the state has not been putting in what it's promised to put in. But the only way the state could have promised to put in the promises that were made is by hiking taxes. Taxes in Illinois are already obscene. On a $600,000 house, one can expect to pay something like $14,000 or $15,000 every year. And do you really own your own house in Illinois? And on top of that, you got 10% sales taxes. We do have a relatively low income tax, but the progressives are out to do that, Gordon. So, and for what? The pensions are so underfunded here, they are going to go bust with the next slowdown. And I think one's on the way. In spite of, all these rosy forecasts, the Fed, everyone thinks that we're going to hike and everything's okay. Report after report. Today's housing number was bad. Industrial production down. Factory orders were negative. 5 consecutive months, and they turned up last month for the first time, barely. So, everyone seems to think that it's some sort of soft patch that's coming.
Oh, no, it is much worse than this.
I think it's likely we're in recession right now.
Yeah, I would agree with that, Mish. I believe we are already in a recession. What we're seeing now is equivalent to what we saw in 2008. By the way, it's been 6 years since we've seen a recession. Normal, cyclical, we should be seeing some kind of it's a healthy process. But we're afraid to see it. But definitely a major slowdown. There's no question that's underway.
Yeah, and the one thing that had been holding up, is jobs, and the last jobs number was bad.
Yeah, but not well-paying jobs.
And look at what they're doing with minimum wages. So, they're clamoring for $15 minimum wages. If you're a company, do you want to expand in the midst of all this growing angst and pressure? And in the case of Walmart and McDonald's, they actually raise minimum wage, but not enough to make these people happy. They want $15 an hour, essentially, just to stand there. And that's one of the problems too. And I expect, because of these wage pressures and the strong dollar, and it's hurting manufacturing, it's hurting exports, and also the decline in oil, we've lost 100,000, and these are good jobs now, 100,000 well-paying jobs in the oil-related industry. And everyone seems to think, well, that we're just, that this is just another soft patch. I don't know. I was wrong, though, Gordon. I thought we were headed for a recession a couple of years ago. But, the Fed stepped on the gas with another huge blast. They started QE3. I think that staved it off for the time being, but at great consequence. We blew another asset bubble. And in spite of that asset bubble, here we are. Pensions still haven't recovered. Pensions are still not close to where they need to be. And we're going to see in the next downturn a lot of cities go bankrupt. They can't now in Illinois, but if Ronner gets his way, and he should, and allows Illinois cities to go bankrupt, I think we're going to see a string of about 5 of them right off the bat.
I've been in the school
all
for
over pensions.
Quite some time, Mish, that I believe the next crisis is not a banking crisis. It'll be part of it. It's going to be a pension insurance crisis.
Oh, absolutely.
That stems and spills into a sovereign country debt kind of issue. Now, Chicago and Illinois specifically, is known to be one of the more troubling underfunded pensions state-wise across the country. But what about a little higher level? What about corporate pensions and the federal pensions? What's your views there? Because I know you've done a lot of writing on this.
Federal pensions is the same thing, except the U.S. is not going to go bankrupt. But again, this is all coming out. any promises that we've made to federal workers is just going to come out of taxpayers' pockets. Let's turn back to Chicago for some of the shenanigans they did that we need to talk about. Chicago floated general obligation bonds and used those bonds to actually just fund current expenses. That's illegal. So we've got bonds here in Illinois that are called tax exempt on the basis of they're supposed to be funding, long-term infrastructure, that actually funding, current short-term needs. So, Governor Rauner has some proposals in Illinois, but guess what? They exempted two of the biggest problems area in the state. They exempted police and fire. Police, fire, and teachers are pretty much 85% of the problem. And, so they exempt from these reforms that he's trying to pass. Not that he's going to get them to pass, because Democrats have a veto-proof majority in Illinois. So, Rauner's hands are somewhat tied behind his back here in terms of what he can do. So, and it's not just Illinois. I mean, look at California. They kicked the can down the road. Under bankruptcy law, cities have the right to be able to shed pension obligations. They pretty much didn't do it, or didn't do much of it, in Detroit. They hardly did any. In fact, I don't believe they did do any in California. So we're going to see some cities that came out of bankruptcy in California. I believe they're going to be headed back to bankruptcy because they trashed the bondholders. And I believe bondholders ought to share in the pain here, Gordon. But we can't totally bail out the pensions on the backs of the bondholders. And guess what happens? These cities, the next time they're in crisis, can't get funding. So California is going to be in a world of hurt. Illinois is going to be in a world of hurt. Those are the two states that I'm aware of most. But actually, you can look at probably any major city in the country, and they all have problems. They're just not realized yet.
And it's not only the cities, as you point out, and the state, but right down to the towns, etc. And for a lot of our foreign listeners that really don't fully understand how it's done here in America, I live just in a little town outside of Boston and commute. We have 55 police officers in this little town on the payroll. We have 3 chief of police and 2 fire chiefs, etc. In actual fact, only 16 police officers show up, 1 chief of police and 1 firefighter. So what's the discrepancy? It's called the rest are pensions. But we didn't fund those. So when they retire, they're just kept on the payroll at a slightly less amount. So how do you increase the taxes? Well, you don't. And that's the problem right across America. They have not put out enough money. Then the money that in some cases it was fully defined, they haven't been contributing. So it's only I think, Mish, it's something like Bernie Madoff's Ponzi scheme here, and it keeps on going until everybody had a run on Bernie's fund, and we have 75 million baby boomers retiring, 10,000 a day right now, and there's no money. It's only a matter of time.
And some of them are retiring not because they want to, Gordon, but because they have to.
Yeah, correct.
I call that forced retirement. They have no job, they have no income, but they need money to live on. So they retire to collect Social Security just because they can. So they're barely scraping by. And they've got any assets in the bank, they're earning 0% interest. And let's talk about that too, because that's part of the pension problem, and that's definitely part of the insurance problem. You have insurance companies, which you mentioned earlier, and I certainly agree, and I've not talked about enough on my blog, but you've got these annuities that are promising 6-7% returns with the long bond, with the 10-year bond at 2%. How does that work? It doesn't work, actually. So the only way they can meet these 6% obligations promises is to take riskier and riskier and riskier bets. So everyone is piling into these things. They're avoiding U.S. Treasuries because Treasuries don't pay enough, 2%. Meanwhile, we get negative rates in Europe because of Bernanke's shenanigans. And these central bankers don't see that they're contributing to the problem. How do you fund long-term assets with 15-year negative bonds? It can't be done. It can't be done in Europe. It can't be done here. Meanwhile, China's slowing, and everyone has this idea, just as they did in 2008, except in reverse. They had the idea in 2008 that China was going to decouple from the global economy, and now everyone thinks that the U.S. is going to decouple from the global economy. Well, it's not going to happen. And meanwhile, Bernanke came out yesterday, and he said there's nothing magic about a 2% inflation target. And that's one of the few things he ever said that I agree with him on, except that that's not the way he meant it. He went on to say that he's open for it to be 3, 4, 5, 6, and for there to be a debate on that. These guys can't even get their 2% inflation target in spite of all this massive QE, because every penny of it's going into assets. And we've got this huge asset bubble that these guys don't even see. And we can't make their 2% inflation target because of all the deflationary pressures, because people have debt. And these guys are talking about a 6% inflation target. And Bernanke also said, that the natural rate of interest is likely negative. That's impossible unless time preferences can ever be negative. And if time preferences were negative, people wouldn't eat and we'd all starve to death. So these guys really don't got it from top to bottom.
These pension plans, all the issues that you already mentioned. Well, and I've been doing a fair bit of work with people on this, is the pensions have aggressively moved out of stocks and bonds as a percentage of their holding. They're still in there, don't get me wrong, but they're moving into alternative investments, alternative assets, and what I'll call those private equities, private placements, etc. Longer term, dated, but they are very, very risky, highly risky. Some of them are great investments, but they're certainly not typically liquid. That is for sure. But they give you longer.
That is one of the problems.
Exactly.
And it just really all boils down to the Fed holding interest rates artificially low. And so we've got pension plans and annuities in a desperate search for yield. And so they're getting it by plowing into riskier and riskier and riskier stuff. And Bernanke said, something to the effect, it's not caused a problem yet.
Yeah, exactly.
Yeah,
like that.
I think he didn't use the word yet, but I used the word for him yet because that's it. And it astounds me. We talk about the law of bad ideas, because Bernanke came by yesterday and he wants a higher inflation target, 4% or 6% or something, and we've also seen in the last 2 days a couple of economists, actually the chief economist for Citigroup, Brutner, how do you pronounce his name, came out and he wants to put a tax on cash and he wants to eliminate currency. And where did this idea come from? This idea came from the idea that deflation is bad, that falling consumer prices are bad.
Well, not for me, they're not.
Even the Bank of International Settlements, the banker's banker, came out with a report a few weeks ago. I talked about it on my blog. They did a study of all these deflations, and they said, you know what? You can have growth with these deflations. Yes. And in fact, there's nothing bad happens then. And the only one that they could point to where anything bad happened in a price deflation was during the Great Depression. But the Great Depression was primarily, an asset bubble depression, just like we had with the shock in 2007. And we're going to have another one because the Fed's overly inflated asset prices. So what's happening is we've got one bad idea. The bad idea is we need to do something about deflation. And when we do something about deflation, we create these asset bubbles. And that unleashes the really destructive deflation, because banks have made all of these loans based off of forever rising asset prices. That caused me to formulate the law of bad ideas. I was shocked to discover that no one had ever written about the law of bad ideas. I looked it up. No one claimed it. So I said, I get to claim the law of bad ideas. And here's the general principle. Bad ideas don't go away until they've been tried and failed multiple times, and generally not even then. And there's a number of corollaries here. Left alone, bad ideas get worse over time. And the overwhelming desire to implement bad ideas leads to compromises that makes them worse. And the worse the idea, the more likely to be embraced by academia and political opportunists. So, and then on top of it all, bad ideas lead to more bad ideas to fix the problems caused by the previous bad ideas. That's my law of bad ideas. What do you think?
We'll attribute it to you, Mish. It's a good one, though. Mish, what we're moving to is pensions are no longer risk-free. We always thought of a pension being risk-free. They're now coming with incredible risk for various reasons we talked about. But, we moved in the last, 15 years thereabouts from defined benefits, and all these issues we've talked about so far have been more or less in defined benefits or annuities structure. We went to a world of contributory pensions. And this is where the future generations, and in their case, they're 401ks or self-funded through IRAs. But the average 401k in America right now is $18,500. There's no pension money in the new generation to retire. There is no retirement funding capability because they're not savings. There's an incredible shift in our economy coming, but it's certainly a crisis here. I think the days of pension, of retiring, could be lost. This could be the last generation.
And look at what the Fed's doing on top of it. They're encouraging people to spend. Saving is now a bad thing when no one's saved enough for retirement. Actually, the top, 2%, 10%, pick your own number. 15% maybe are comfortable in retirement. And then there's another 10% maybe that'll just barely scrape by. And that's it. Everyone else essentially can't retire, or the retirement sure is not going to be, what they thought it was going to be 20 years ago. So, and of course, the top 1% are very well off, and the top 1/10 of 1% are unbelievably wealthy, more money than they know what to do with. So, and that's all part of your average 18,000. Is you've got people that are sitting there with billions in assets. So that 18,000 is really, quite suspect. When all these billions are floating around, $18,000 doesn't look like much because it took all of these billions to raise it up to 18,000.
Yeah, we're on the cusp of what I'll refer to as pension poverty, a new era, and that's what it's going to be. If you even decide you can retire. And with the shortage of jobs, and let's make no doubt about it, there is a shortage of jobs that pay any kind of decent income. You just can't get by. I walk into grocery stores and people that are packing the bags are in their 70s and just trying to make a go of it. And it's getting worse at an accelerating rate. But, I was going to ask you, what's the government doing about it to help protect? And really what we're saying is they're the problem. The government.
Well, yeah, they're doing the wrong thing. Look at it this way. Here. What is the average person on retirement fixed income? What's the last thing they want? Last thing they want is for prices to go up. What is the Fed trying to do? They're trying to get prices to go up.
Yeah, every time they hear that inflation's going to 6%, I'm sure they break into a cold sweat. Because that's what financial repression is. It's a transfer of purchasing power from savers and to those who are indebted, like governments, or highly leveraged on debt. That's the transfer, and it will go on for a sustained period of time.
So it's a transfer to those who have first access to money. Who's that? The already wealthy, the rich, banks, and government. You know why? How government? By property taxes. When prices go up, they collect more in sales taxes. When home prices go up, they collect more in property taxes. So it's all about taking more of your money and under the guise of we can spend your money better than you can, while also attempting to force prices up. So people complain about these living wages. The problem isn't the wage. The problem isn't the minimum wage. The problem's been price inflation over time, where the average guy on the street has seen a decline in real wages. Whose fault is that? Well, it's the Fed. They're the ones that believe we need prices to go up, even though deflation is the natural state of events. Because of improved technology over time, prices left alone would tend to decline. The Fed doesn't want that, and so they try and counteract it, and they're just bringing about the very problems of over-indebtedness.
Mish, is there realistically any key things that could be done? Now, I was going to say should be done. There's so many, but could be done by our elected officials.
Well, I just take a look at the state of Illinois. Springfield could and should allow municipalities to go bankrupt. There's 5 of them that want to do that, and the only way they can shed these pension obligations is through bankruptcy. Now, the federal bankruptcy statutes are such that they give states the right to decide whether or not their municipalities can go bankrupt or not, and how, and under what conditions. Now, the weird thing is, once states allow the cities and municipalities to do that, then the bankruptcy law itself is under federal jurisdiction. So if Illinois allows cities to go bankrupt, they will be able to do that, and laws on the books of Illinois that say pensioners need to be protected first actually go out the window. And so that's one of the reasons why Illinois here is reluctant to let cities go bankrupt, because they're trying to protect the pensioners on the backs of the taxpayers. And whose pensions are they trying to protect? Their own, Gordon.
Exactly.
The legislatures have their own pensions. The judicial systems have their own pensions. The teachers have the police and fire. All the state workers have their own pensions. They don't want to see those pensions go, so they're not going to do the right thing. The only way to fix that is to get a whole clean slate of legislators who don't have these accrued benefits, and they might do the right thing.
Well, we have a two-class society. They're the only ones that do have anything that is a pension today.
That's correct.
There's nobody else that's got a pension. They just kind of roll their eyes. And I was talking to a lot of young people, and and they're looking at jobs, and what came out of their mouth was, and I asked them, and they said, "Oh, I want a job with the government," and it was like, "What do you mean? Like where? What?" No, they just want to work for the government, because to them it means no layoffs, job security, good pay, and lots of benefits that their parents are complaining about and parents are pushing. When I was a young man, that was not where people were targeted. They wanted to create businesses, etc. So there's a shift. There's a shift in the new generation of where they see things ahead.
I keep trying to figure out, Gordon, when and how this all ends. It's definitely going to blow up. It's going to culminate in a whole bunch of different ways, perhaps at the same time. Certainly a pension crisis, an insurance crisis, if we've got a huge decline in the stock market as I expect, you've got everywhere you look, central banks are going nuts in Japan, in Europe, in China. So I'm expecting a currency crisis on top of all of this. And it's certainly not inconceivable that all of these things happen all at once.
Well, the biggest pension plan in the world is the Japanese pension plan, and it's selling its bonds in a fairly large way, selling them. Who's buying them? The Bank of Japan. Isn't that interesting? Who can't sell them anywhere else. And they're buying equities. And they're buying not only the Nikkei, the pension plan, but they're buying foreign equities. That's kind of like trying to protect the store of value as they debase the yen, which has been basically in free fall here for a couple of years now. And if they keep doing what they're going to do, it's going down further. I mean, that's their intent. So yeah. It's a convoluted set of structures. What, Mish, we got to wrap, but what should investors do with these kinds of, not pensioners, but investors with these kinds of problems on the horizon?
Well, my top trades now are actually, I think, if you look at the average PE of the Russian stock market, it's something like 6. So I think the ruble might have bottomed. So we're going to have some strong, tailwinds here for Russian equities. I mean, certainly there's a risk that Putin takes over these industries, but actually, if you look at what he's doing, for the first time, Russia said, no more meddling here for 3 years in businesses. So they've got kind of like a hands off there. That's an environment here that can really take off. So I'm bullish on Russia. I'm bullish on Japan, but hedged for a decline in the yen. So in other words, I like Japanese equities, but the way to do that is to look for an ETF, and there's a couple of them out there where you can buy Japanese equities hedged for a decline in the yen. And there's a possibility there that trade works out in both directions, that not only does the yen decline, but stocks even rise more. So that's my second key trade. My third trade I've been wrong about, as you know, for several years now, 2.5 years maybe, is gold. And gold gold started declining when Mario Draghi came out with his "we'll do whatever it takes" kind of thing. I think we're going to see whatever it takes blow up at some point. And actually, starting in November or so, gold, in spite of a rising dollar, and especially gold miners, have been relatively firm. So that would be the third leg of my investment strategy, would be gold and gold miners. So those are the things I like. I think all those 3 asset classes are undervalued, and that's where I would have the predominant portion of my investment, and that is where I do have the predominant portion of my investments.
They're all in many ways a bet against, in some ways, the U.S. dollar. And I say that in that we're talking about a Japanese where you're hedged to a fall in the yen. That is a currency bet, and is the herd carry trade. Russia, we know what's going on there, but it's really a currency. And in gold, it actually has been in a bull market, except the United States, because of a strengthening U.S. dollar. So the dollar begins to weaken.
Japan plays not a bet against the dollar; it's actually a bet against the yen. But certainly, well, I mean, the Russia is just a pure value play. It's a bet that Russia doesn't collapse, and I don't think it will. And on that basis, it's very undervalued. Actually, if you look, though, the ruble is actually one of the better performing currencies. In fact, I think it is the best performing currency this year, one of the few that's actually risen versus the U.S. dollar. Yeah. So that's kind of interesting. So that's a two-way bet, and we'll see. Everyone's worried about a taper tantrum, and I talked about this on my blog yesterday too. and by taper tantrum, they mean that the Fed is going to hike. I think what they ought to be worried about is an untaper tantrum, that the U.S. economy is so weak that the Fed can't hike, yet because of the increasing dollar versus primarily the euro, and also because of declining earnings due to the rising dollar, and also due to rising minimum wages. Now, we've got the recipe for a huge decline in U.S. equities here, and that would be my last bit of advice. If you didn't like the rest of what I said, then get out of U.S. equities and go to the sidelines.
Exactly. Mish, my comment earlier about the yen falling, which I do see going, and the U.S. dollar, is more remembering that the biggest buyer and the only significant buyer of the U.S. Treasury right now is, in fact, Japan.
Mm-hmm.
And there's a huge carry trade, and that's the correlation that's so tenuous in all three, that ties into all three of those areas. Which, by the way, I feel I would support your thinking on that. Mish, any last comments you'd like to leave with our listeners before we break?
No, I think we covered it all here. We've tied up the financial repression bit nicely. We covered pensions and insurance today, and we even covered some investment ideas. So I'm happy with this video cast.
I appreciate it. I thank you for the time. And it's nice to have spring in New England. And I guess you're glad to see spring in Chicago, right?
Yeah. And one more thing.
I'm looking out that window of yours and seeing how nice it looks.
People can find me globaleconomicanalysis.blogspot.com. That's a mouthful, so the easy way to find me is just do a Google search for Mish, M-I-S-H. That'll take you straight to my blog. I talk about these things typically 3 or 4 times a day, 7 days a week.
Nobody covers it better than Mish, and I strongly recommend our listeners who haven't been to his site to go to it. We'll have you back again, Mish, and I always look forward to talking to you.
Pleasure to be on the show, Gordon.
Talk to you. Bye. Thanks.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.